CDS, not CDs, okay? CDs are basically your bank certificates, okay? Certificate of deposits, these are the ones that you give to your bank for a time period of, 6, 12, 24, 36 months or whatever, and they give you a percentage. You can't access the money unless you take the penalty, whatever. It's a way for the bank to get liquidity or get capital from you and give you peanuts to do it and convince you that it's worth it. Credit default swaps, okay? There's 3 parts to this, okay? It's not just one word. There's 3 very big parts. What is the credit? Where does the credit come from? Default, the protection of, or what leads to, and who is swapping it, all right? That's what we're going to focus on. So, like I said, credit to Khan Academy. I can't remember their exact video, but I remember a lot of it. Okay, so let's talk about how this happens, okay? Let's think about a company that has money right now. So let's talk about, let's just call it this. Let's call it a fund, okay? And this fund has a lot of regular people's money, okay? So let's say this is a pension fund or a retirement fund, okay? So a retirement fund or pension fund, and it has, teachers and fire and police, the whole 9 yards, right? So one of the things that they're required to do is to not make anything too risky. Now, I don't mean that teachers fund that was in Kentucky that had a bunch of Russian investments that went bankrupt, RIP to Kentucky teachers pension, but a retirement or pension fund, okay? Public employee retirement fund. And they've got cash sitting on the sidelines, right? Because they're trying to be very safe, right? So what they do is they invest money, but they whatever. They don't want to be too risky. And they've convinced and they've told all of their shareholders, we are not going to do anything too risky. So now you've got a company over here that needs money, which all companies need money. Well, let's call it Peloton. And Peloton is like, hey, we need to borrow some money. So we're going to offer bonds, corporate bonds. And so they're looking for somebody to buy their corporate bonds. And they say, hey, we're offering corporate bonds at, 10%. Big money, right? Big money. But we need $1 billion or we need $10 billion. So this pension fund is like, holy shit, wait, we could give them $1 billion for 10 years and they're going to give us $100 million back every single year for 10 years. And then in 10 years, we get our $1 billion back. That's fucking good, right? Who wouldn't want that? That's amazing. That's why corporate bonds, they always pay, right? So what happens though, is that remember, these guys had told their people that invest and say, hey, listen, we're not going to invest in risky shit. That's fucking risky. And they don't have a good credit rating because they're already in debt. They've already got problems. So if they tell their people, hey, we're only going to, and this is back to 2008 for those of you guys remember, we're only going to invest in AA, AAA, and AAA plus companies with credit rating companies so that we don't expose ourselves to too much risk, right? But Peloton is like a B- at best. So they can't do that, but there's always a way around. So who is in charge of the rating companies? Does this tie into the Credit Suisse situation? I'm not gonna read chat because I feel like you are fucking trolling me or goddamn stupid. I said I'm talking about credit default swaps. Does Credit Suisse on here anywhere? Who's in charge of the rating system? Moody's is one of them. But Moody's is not regulated by any entity. They are a pay-to-play service. Oh, did I say that out loud? I'm sorry. They are an independent service. So what you do is you find a go-around. There's always got to be a go-around. Here comes your bank. Now this could be Lehman's. This could be Credit Suisse. This could be AIG. This could be Citi. Could be anybody. And they have a great credit rating. Moody's gave them an AA. So now, because Moody's has given them a AA rating, they can now insure this company for a kickback. So what they do is they say, okay, we're going to lend our rating as insurance. We are going to insure this company's debt on this transaction. And we're going to require a percentage. So now, instead of getting 10%, they are going to charge these guys, or these guys, however they sign it up, a percentage of that kickback, right? So instead of 10% going here, they might take 2% of that. So now you're getting 80 million per year on your purchase of that $1 billion 10-year corporate bond. And these guys are basically saying, hey, we're going to cover. If anything happens to them, we're going to be able to cover you guys. cover that debt. But in return, we're keeping $20 million per year. And that sounds good on paper, right? We're making $20 million a year for 10 years. We're insuring this $1 billion. These guys aren't going under. Everything's fine. These guys are getting their $80 million and their $1 billion back. And Piton's got their $1 billion. Everybody's win. This is like your parents being the co-signer here, okay? Except they're actually making money on this. Now that sounds great on paper. And if this was you and I, ain't no fucking way anybody's letting that, right? They're gonna jack the interest rate up, or they're gonna do whatever. But here's the kicker. Number one, they don't have to have that cash on hand. Uh-oh. Wait, you're telling me that they're insuring $1 billion, but they don't have $1 billion? Yeah. Okay, well, they've got a market cap of 20 billion, right? Or 10 billion. That's okay. It's only 10%. I'm sure they'll be fine. Oh, by the way, I'm trying to hurt as many people as I can right now. They're doing the same thing with these companies. What happens if they have 40 of these out at one time? Which is not unheard of in a 10-year period. So now they've lent out, or they've insured 3 or 4 times their own market cap and have no cash on hand in case something happens. Now, I just basically broke down a lot of what happened with the subprime mortgages and whatnot, okay, in 2008. Now, U.S. banks came under regulation since then, but Credit Suisse is not a U.S. bank. It is an international bank. And when everybody else had to get their shit together, Credit Suisse says, I'll fucking do it again. So now the problem is the collapse, the effect. Let's say Piton goes underwater, okay? Well, the pension fund might have made 1 or 2 years. So they made 160 million or whatever. That's great. But now they're owed 1 billion. Well, Lehman, Credit Suisse, AIG, Citi. I'm just throwing names out there. Because remember, this whole time, Moody's should have fucking downgraded them, right? Because if you're a credit rating system and you see someone has 4 times the leverage in shit loans lent out, they shouldn't have a AA rating. But once again, they're paid. I'm sorry, not paid off. Excuse me. They're independent, and they may miss that somehow. And so, because they keep their AA rating, they can continue to do this over and over and over again. So now Piton goes out. These guys got to cough up $1 billion. They can call in loans, stock offering. They can do different things. But here's the problem. Let's say the market goes under. Companies start getting illiquid. They have no capital. They have no ability to pay anything back. They can't pay back their creditors. Now 2 of them are gone. Now 3 of them are gone. Now 4 of them are behind. You don't have any capital on hand. You don't have any cash on hand. You can't do that. So you have 2 options. Either you basically run a short-term Ponzi scheme and take on more clients in order to get money to pay back the pension fund, or you go under. And now, these companies are gone, and these pension funds are wiped out. And you as a teacher or a fireman or whatever have lost everything, and you didn't do anything wrong because the little guy gets hit the hardest. I'm not trying to scare anybody or anything. I'm explaining to you what credit default swaps are and how they can affect everyone. How is a company like Moody's that is part of the loan investment system not regulated? Well, think of Freddie Mac and Fannie Mae as well. Now, a lot of these things changed. Now, prior to 2008, they were completely independent, okay? Now they're not so much. There is federal government regulation. I was just explaining how credit default swaps works. Obviously, things have changed since then, but remember, once again, this is just how I was explaining how credit default swaps have worked in the past and how they work. I just use Moody's as an example. So that is what a credit default swap is. And then if everything's good and the market's bearish or bullish and everything's good, no one ever knows. Everyone makes money. Everyone's happy. Everyone shuts the fuck up. Now, Credit Suisse has other problems as well. For those of you guys who remember, a certain individual, who I'm not going to say his name because I always butcher it, lost like $2 billion in a week. Okay, so they already were hurting. Imagine one of your own people fucking lose like $22 billion in a week. Bill Huang, as it were. How do you earn money on CDS? During a bullish market over the course of 5 to 10 years. Here's your pension, okay? Here's your company, and here is your cosigner. I'll just call it cosigner. They give them $1 billion. Company then gets to take $1 billion and reinvest it or do research and development or expand, whatever. They get 10 years to do something with this. All the while, these guys are making $80 million per year in interest and getting their $1 billion back at the end of 10 years. I mean, they're going to make back an ungodly amount of money. I mean, they're going to make, $800 million theoretically in interest and then get their billion back. They're lending out money on speculation to a company they shouldn't because they're getting the cosigner here. And these guys, if nothing happens in that 10 years, are getting a free $20 million every year for 10 years. That's $200 million. Just to say, yeah, we got you. We got you. No problem. So now they make 800 million, get their 1 billion back. They make 200 million. They don't do anything. And these guys got 1 billion to do a lot of here, now, whatever, whether it's a buyback, right? Stock buyback. You know, you could raise your market cap by 2 billion in the next 10 years or 5 years or 3 billion or 50 billion with that money, right? But remember, they're not supposed to lend to anybody with shit ratings because they promised their pension people or their regular people, we're not going to fuck you over and do this. They shouldn't be taking anybody. Nobody should be loaning money to them because they're a shit business. They're B-, right? Nobody should be. That's a lot of risk. Nobody should be doing it. But then everybody says, well, these guys are AA. They're good. They're good for it. So fuck it. That means these guys are basically an AA because I'm not even loaning money to them. I'm loaning money from them because they're going to pay it off if anything happens. So everybody's happy and everybody's making money. Problem is people get too cocky. It goes out too much. And then a global crisis happens. You have one guy who loses $2 billion in a week, and then you have a global crisis. Next thing you know, shit caps up to you, and you're under that. It's like how many people do you know have money but don't have money? When I hear about this, and a lot of people will get on to me about this and say, oh, well, Stocky, you always make excuses for rich people. You always make excuses for this type of people or whatever. No, I'm not. I talk about things relative to society. Because if you're sitting here getting mad about me saying somebody making $250,000 a year living paycheck to paycheck, and you're making $55,000 saying, fuck them, live paycheck to paycheck, they're stupid. You're $50,000 living paycheck to paycheck. Somebody making $22,000 living paycheck to paycheck is going to think you're a piece of shit. I just bring things out in a relative basis.